Welcome to the stock market. Investing in the stock market can feel like entering a bustling city full of energy and constant movement. Everywhere you look, numbers are flashing, arrows are pointing up and down, and people are making decisions at a rapid pace. It can be overwhelming, especially for beginners who are just starting to navigate this complex environment. But don't worry, you don't need to be a financial whiz to navigate this exciting world. With the right guidance, anyone can learn. Just like any good explorer, you need a map and compass to guide you through the stock market's twists and turns. In investing, those tools are called technical analysis and fundamental analysis. They help you make sense of the market. They are two different approaches to understanding stocks and making informed investment choices, each with its own strengths. Think of it like this. You're trying to figure out if Gromit's new dog biscuit company will be successful. You could simply look at the price chart of the biscuit stock going up and down, tracking its performance over time. Or you could investigate the company's ingredients, recipes, and overall business strategy to understand its potential. Both methods can be helpful, and understanding them is key to becoming a savvier investor. With practice, you'll gain confidence and insight. Charts and crayons, the technical side. Technical analysis is like studying the footprints left behind by other investors. By examining these footprints, analysts try to understand the behavior and sentiment of the market. Imagine a muddy field after a rainstorm. The footprints left behind tell a story of who walked through and where they went. You can't see who walked through the mud, but you can see their footprints. These marks give you clues about their journey. Technical analysts or chartists look at charts of stock prices over time. They believe that all information is already reflected in the price. They search for patterns and trends that suggest where the price might go next. These patterns can be as simple as a trend line or as complex as a head and shoulders formation. They use tools like moving averages, which smooth out price fluctuations, and trading volume, which shows how many shares are being bought and sold. These tools help them make more informed decisions. Technical analysis is like trying to predict the weather by looking at cloud formations. Just as clouds can hint at upcoming rain, price patterns can hint at future market movements. It doesn't tell you why the weather might change, but it can give you clues about what to expect. Similarly, technical analysis doesn't explain why prices move, but it helps traders anticipate future movements. It's particularly popular with short-term traders who buy and sell stocks quickly. These traders rely on technical analysis to make rapid decisions and capitalize on short-term price movements. Digging deeper, uncovering fundamentals. Fundamental analysis is like being a detective investigating a company's true worth. It involves a deep dive into the financial health and operational efficiency of a business. Instead of footprints, we're looking for financial clues. These clues help us understand the company's performance and potential. Fundamental analysts examine a company's financial statements, such as its income statement, balance sheet, and cash flow statement. These documents reveal the company's revenue, expenses, assets, and liabilities. They also consider things like the company's management team, its competitive landscape, and the overall economic environment. These factors can significantly impact a company's future success. The goal of fundamental analysis is to determine the intrinsic value of a company, what it's actually worth based on its underlying business. This helps investors make informed decisions. This is like figuring out the value of Gromit's dog biscuits by looking at the quality of the ingredients and the efficiency of his baking process. The better the ingredients and process, the higher the value. Fundamental analysis is often favored by long-term investors who are looking for companies with strong growth potential. They seek businesses that can grow sustainably over time. Section 4, and the winner is a tie. So which approach is better, technical or fundamental analysis? Just like Wallace can't decide between cheese and crackers, there's no single right answer. Both methods have their strengths and weaknesses. Technical analysis is relatively easy to learn and can be useful for spotting short-term trading opportunities. However, it relies on past patterns to predict the future, and it doesn't consider the underlying fundamentals of a company. Fundamental analysis provides a deeper understanding of a company's financial health and growth prospects. However, it can be time-consuming and complex, and it doesn't always accurately predict short-term price movements. Section 5. finding your investing groove. Ultimately, the best approach for you depends on your investment goals, time horizon, and risk tolerance. Some investors use a combination of both technical and fundamental analysis to make more informed decisions. Think of it this way: if you want to buy dog biscuits for the afternoon, you might just choose the cheapest one available at the store. But if you're stocking up for a year, you'll likely want to consider the ingredients, the brand reputation, and read some online reviews before you buy. Investing is similar. Understanding both technical and fundamental analysis can help you become a more confident and successful investor, no matter what your investment style.